We know the bond market is going to move once those job numbers are released at 8:30. The hard part, of course, is figuring out which way. Bill O'Donnell has a pretty good idea because he has asked his clients. Bill's head of Treasury strategy at RBS Securities in Greenwich, Connecticut. That's where he is this morning. Bill, glad you could join us. You survey your clients ahead of the jobs report every month. This time around, you found they're growing more reluctant to take risks. Why is that?
Well, we're coming into a period where year-end balance sheets are being tightened up. We see that in the dealer community, and it's strongly in evidence by the growing illiquidity of the Treasury market. And again, that's as sort of customers and dealers tighten up the books for year-end. And in our survey, what we did find is an equal balance of people who will be looking to sell on a weak number today. That is, if Treasury yields fall, prices rise, people looking to take gains if the market rallies, and an equal number who would like to buy a dip in the market should the number come in stronger than expected.
How reliable is this survey over time?
It's very reliable when you get a heavy skew of buyers on dips relative to sellers on strength, or vice versa. So the fact that we have a relatively even balance between sellers above and buyers below tells me that the ranges that we've seen in Treasury yields over the last 2 months or so are likely to persist, perhaps all the way to year-end.
Does this risk reluctance have to do with the fact that returns in Treasuries, if you're haven't been that great, even if you're a shorter this year?
Well, I think it has more to do with the fact that people seem to be on both sides of the inflation equation and what all this, monetary stimulus means. It seems like half of the Treasury market expects for very weak consumption, disinflation perhaps, or very weak inflation for the next 6 to 12 months. But there's another half of the Treasury market crowd that seems to be very concerned about the fact that all of this Fed liquidity is likely to boost inflation in the months and years ahead. It's going to take a long time for one side of the argument or the other to effectively win out through the data. So for the foreseeable future, the market seems to be, as I would call it, in a nervous stasis or in a trading range.
All right, Bill, thank you very much for joining us this morning ahead of the jobs report. That's Bill O'Donnell from RBS Securities up in Greenwich, Connecticut.